There you go. That sounds good.
Fabulous. So, just another quick intro. This is Steve from PCI talking about restructuring and insolvency, something that's really important for bookkeepers. And take it away, Steve.
Thank you. Yeah. Look, thanks for the opportunity to come and talk to you today, and particularly during your lunchtime. So my role, I'm a registered liquidator, and I'm also a trustee in bankruptcy. So companies go into liquidation and people go bankrupt. So that's the difference between the two. But in a lot of cases, you'll get maybe in the media or people telling you that they've gone bankrupt, where their company's gone bankrupt. It's actually gone into liquidation, and where individuals actually go bankrupt. So the big one at the moment that's got a lot of media publicity is Bonza. So the airline fell over at the beginning of the week. That's gone into voluntary administration. So I'll cover a little bit of those sort of things today. What I'd like to do is encourage you to actually ask any questions. If you are viewing this recording, my details are at the end of the recording. If you've got any questions or want to ask anything particular about insolvency, just reach out to us and we're happy to actually take you through and try and give you the answers that you're seeking. So I will share my screen, but in the most part, I've got a couple of slides, but in the most part, I'll just really be doing a lot of talking. So let me try and do that. Okay. Okay, can you see that?
Yep, that's coming up perfectly.
Oh, fantastic. There you go. Well, the technology's actually worked pretty well for us. Okay, so hopefully it continues that way. All right, so there are my details. Okay, so the way that I've structured this presentation for you is you guys are at the coalface, so you see a lot about what's going on with your clients. Depending on how many clients you've got, you probably see some are doing well, some are maybe not doing as well, and some are really really struggling. And we're really busy at the moment. The insolvency landscape has changed, particularly this year, and it probably changed probably from middle of last year, and it's just getting busier and busier for us. And I'll tell you a little bit of reason why we think that's actually the case, and probably what's likely to happen, over the next 6 to 12 months. So I'll cover that off first about what we're actually seeing from our perspective, and then I'm going to just take you through the different types of insolvency. But I'm going to talk to you in particular about, because most of your clients will be probably small, maybe to medium sized business. I'm going to talk to you about small business restructures and how they work. So I don't know if many of you have heard about the small business restructure regime that was brought in by the government in the start of 2021. But I'll take you through that because they're becoming very popular as a way of actually rescuing and saving small business. So what we're seeing at the moment, let's go. So as I said, we're really busy, and the reason that we've become really busy is fairly simple. Um, Tax office is taking a lot of action to collect the billions of dollars of outstanding debt that's actually owed by small business. So I think that we did a webinar with the ATO probably a couple of months ago, and they went through some of the debt collection techniques and tools that they've got, and also the amount of debt that's outstanding. It was some astronomical amount of money, like something like $50 billion was presently outstanding. It was an enormous amount of money, and what it sort of anecdotally, I think what's happened is that we had the bushfires, and you might recall back if you want to recall all these bad things that have sort of happened to us over the last sort of 5 years or so. So we had the bushfires first, and then the bushfires at that stage, the tax office sort of put a halt to a lot of the debt collection activity that they were doing. And then the pandemic came along very quickly after that. And of course, that changed the landscape again. And if you recall back to the pandemic, what we ended up having was, if you wanted a payment arrangement for a client, you just ring the tax office up. You could go through the automated service, and you would generally get uh, a pretty good type of payment arrangement. Um, and so that continued, and then coming out the other side of that, we had some floods. Then the government had insolvency restrictions that were in place during the pandemic, because what they wanted to do was they wanted to try and make sure that small business or businesses generally didn't fall over, and trying to stop what they thought would happen, which was an insolvency tsunami or a wave of insolvencies flowing through. Now, um, that hasn't happened, but ultimately, what has happened now is that taxpayers. There were quite a lot of taxpayers, and you might have clients that fit into this category where they just weren't paying their tax, and now all of a sudden, the tax office wants the money, and so they're taking a lot of steps now to try and collect those monies. And effectively, what happens is the more activity that the ATO does, the more tools that it uses to try and collect these outstanding billions of dollars worth of tax debt, the busier we become. Okay, and you can think about that is, let's say, and I'll take you through the various tools that they use, but the tax office all of a sudden maybe contacts one of your clients and says, we need our tax debt paid. All of a sudden, your client will approach you and say, well, what am I meant to do in relation to this? And you might sit there and say, actually, you really can't pay it. Your business might not be viable. This is actually a very large debt, and it's going to be very, very hard for you to meet that obligation. So, in terms of doing that, then where do you turn? Well, you might turn to an expert that actually deals in this type of area, and that's generally an insolvency practitioner. So, as an insolvency practitioner, I meet with a lot of clients that are referred to me by bookkeepers and accountants and solicitors, and I meet with them primarily because these companies have got financial problems, and probably 9 times out of 10 in that SME space, it's a tax problem that they've got, and they need some solutions. They need some advice in relation to what their options are to actually deal with these types of problems. And so, being an insolvency practitioner, we're skilled at looking at balance sheets and looking at the financial information and asking, we've got somebody, I'll just omit them, and asking somebody, um, you know, questions about what they want to do within their business so that we can actually provide them with solutions as to what they can actually do. All right. Still got a few people coming in. All right. So basically at the moment we're getting a lot of people approaching us because they've got notices, they've got communication from the ATO, and they can't meet those obligations. So what sort of stuff is the ATO actually doing? Well, I'll take you through that now. Okay, so you'll see there, and you can see that I'm not reading really off the slide as such, but the tools that are available are garnishees. So what a garnishee is where the tax office will have some information, maybe about the company's debtors or accounts receivable, and they will send a letter out to a particular customer of a company and say, rather than remitting the money back to the company, we need you to remit a certain percentage to us because they've got X, Y, Z dollars in outstanding tax obligations. So it's a garnishee. So and they can do it to bank accounts as well. So in some cases, where they get that information is you might be asked to submit maybe an accounts receivable ledger, and they may very well go through that and then write out, if you can't get a payment arrangement with the tax office, they might write out to those debtors and say, you need to pay us maybe it's 20%, 25% of the amount, in order that it starts to reduce the tax obligation. They might get from maybe the company's tax return where the company actually banks, and they might write out to the bank and say, if you've got money that's sitting there, so in other words, there's actually money in the account, we need you to pay X amount of dollars to us. So that's a garnishee, and we're starting to see a few garnishees being issued. That's not great for a company because the garnishee just means less money that the company's got available to it to meet its obligations. And generally speaking, when we're looking at these types of issues that companies face, they need all the money they can get because they need the money to continue to trade. So the part of the reason they haven't paid maybe their ongoing taxes is because their cash flow doesn't allow them to actually meet all their obligations, and all they're doing is they're continuously paying money to try to ensure that their business continues to trade. So garnishees, we're seeing a few of them, not huge amounts, but we're seeing a few of them. What we are seeing is director penalty notices. Okay, now these, it's critical that you understand for your clients what a director penalty notice actually is. So the director penalty notice makes the director personally liable for the tax debt that is outstanding. So to give you an example, there are two types of penalty notices that can be issued by the ATO. There's a notice called a lockdown director penalty notice. And a lockdown director penalty notice, the only thing that a director can do in relation to those is to actually pay the tax debt. So that if the tax debt gets paid, whether it's by the company or by the director, then obviously there can't be, there's no more obligation. But generally what we find is you'll get one of these lockdown director penalty notices issued, and the director becomes personally liable for the tax debt, and the tax office can then sue the director to try and recover the money that's actually outstanding. So it relates to PAYG, GST, and withholding. So though and superannuation as well. Now, a lockdown DPN, they're deadly. Okay, obviously because if they're issued, then the director becomes liable, and there's not really anything that they can really do about it apart from pay the debt. They come about because of late lodgements of returns. Okay, so it's really important that you encourage your clients to lodge their returns on time, because if they don't, somewhere down the track they might get one of these types of director penalty notices. Okay, so sometimes what we find is that you might have a client and they get all this correspondence from the ATO. Sometimes they never open it. I've had clients where we've gone and all of a sudden, the company's gone into liquidation. We've got all this correspondence and it's all in envelopes that are unopened. And I remember one example where we got basically a big bunch of envelopes, none of which were opened, all from the ATO, all trying to claim amounts and encourage payment, and including director penalty notices that had actually been sent. So sometimes the clients just, they just bury their head, and sometimes they just don't want to deal with the problem. But that's as a bookkeeper, as the accountant, as the trusted advisor of the business, it's your job really to try to encourage them to try and deal with these problems. And sometimes that means going and seeing an insolvency practitioner. And sometimes, it might not be palatable to go and do that, but the sooner they do it, generally the better the outcome and the more options that are available. The other type of director penalty notice isn't as bad. So it's bad, but it's not quite as bad. And it's called a non-lockdown director penalty notice. So what that means is that um, if the company does something within a period of 21 days from the date of the notice, so it's not from receipt, but it's from the date the notice is issued, then the penalty will get remitted. Okay, so the director won't become personally liable for it. So it's to do with probably where the lodgements have been done on time, but they just haven't been paid. Okay, so which is probably the best way of dealing with these things. So they lodge. Really, what a client should do is they should lodge their return, and then they should say, okay, well, I haven't got the money to pay it. Then you either enter into a payment arrangement, but you have communication with the ATO about the issue. And if there's one takeaway that should come out of the discussion we're having today, and that is that communication is the key. Communication with the ATO is the best way of actually dealing with ATO issues and debt and problems. If there's no communication, then you'll find that some of these things will actually take place because the ATO doesn't know what's going on. They'll issue these types of things to try and recover the debt. So the non-lockdown DPNs, there's basically a number of things that can be done. So the debt could be paid. That would be the first one. The company could go into liquidation. The company can go and do a small business restructure, or the company can go into voluntary administration. And if any of those three things are done within the 21 days, the penalty will get remitted. Okay, so it's really important that if you get a client that gets one of these letters or one of these notices, that you deal with it really quickly. And that again, that's talking to an insolvency professional about what the options are. Because if the 21 days expires, you're going to get an extension of time to these notices. If it expires, they become on the hook for the tax debt. So it's just really important that you actually deal with those. Now, the registered office, or if you're doing the tax lodgements or whatever, you might not necessarily see these notices being issued because they go to the director's residence as recorded in the ASIC register. So it doesn't go to the accountant's office. It probably won't go to the company's office. It'll go directly to the director. And sometimes we have accountants that come to us and they say, the first time we knew that their client had received a director penalty notice is when they've gone onto the director's portal with the ATO and looked at their RBA and they've seen this big amount all of a sudden appear as being a liability that's due by the director personally. And they've gone, what's this? And then all of a sudden they've been able to work out that the ATO has issued a director penalty notice that's expired, or a director penalty notice has actually been issued. So you might not see it, but again, it's an important thing as to why, in particular, tax debt needs to be dealt with very seriously. So the other things that they can do is they can disclose to the reporting agencies. So this is like Equifax, for example. They can disclose that there's a tax debt outstanding by the company. And originally, when I heard about this, I thought, what's the real impact of doing that? I couldn't quite see, okay, it might appear on someone's credit file, but I'm sure lots of other things appear on the credit file as well. But so what actually happens is a lot of the larger companies they subscribe to these bureau services, these credit reporting agency services, and when there's a new entry that comes up in relation to one of their customers, they will generally get a notification of that. And I was talking to a credit manager at a large company not so long ago, and he was saying to me, "You wouldn't believe how many of my customers have notifications that have come through in relation to having tax debt." And he says, "I know because I get an email in the morning from the reporting bureau saying XYZ company has a new entry on their credit rating or their credit reference, and it's for X amount of dollars in unpaid tax. And so what ends up happening there is that he said, well, I said, what do you do then when you get notified that one of your customers has actually been reported to the reporting agency? And he said, well, we're concerned and we put them on stop. We put them on stop credit so they can't get credit. So even though their account might be okay, because they've got this default that's appeared on their credit reference, they actually put them on stop credit. So you can see the impact of that. And again, you've got clients that have that, then basically they need to deal with it in order to try and get rid of it. Now, I understand I've been told that what ends up happening is if you then go and get your client then gets a payment arrangement with the ATO then lifts that reporting so it doesn't sit there forever and a day. So I'm not sure if that's true or not. That's certainly what I've been told by one of the reporting agencies when I've asked them the question about how this actually works. So disclosures of credit reporting agencies is another tool they've got. And then the other tool that they've got is winding up applications. So what ends up happening is if they can't encourage through all the other means to try and get their debts collected, they can apply. They issue what they call a statutory demand. So that goes to the registered office of the company for the amount of the tax debt. If within 21 days of issuing that statutory demand, the debt hasn't been paid, then the ATO can then apply to the court to have the company wound up and a liquidator appointed. So as a liquidator, I do some of this work through the ATO approaching us through their solicitors to act as liquidators of companies where the tax debt hasn't been paid. So at the moment, it'd be fair to say that they're probably looking at the larger amounts because certainly the matters that I've received where the ATO has actually made that application, most of the amounts are actually pretty large. But when I say large, we're probably talking about somewhere maybe around 150,000. And what will end up happening is if it's anything like what happened pre-pandemic, the ATO is actually one of the major creditors out there that applies to wind companies up. So the key thing here is that if you've got clients and they might have a payment arrangement with the ATO, they might be struggling to meet that payment arrangement. They might not have a payment arrangement and they might be just too scared to actually take that step to try and deal with it because they don't know what the ramifications are. If you've got clients that fit into that category, or that you've got clients that they might not have actually done their lodgements because they're scared that by doing the lodgements, they then notify the ATO of what the debt actually is. By the way, when that happens, I mean, a lot of companies these days, if not most of them, are on single touch payroll. So the ATO probably knows a fair bit about what some of the tax debt actually is. So they're running big risks, and the directors run a big risk personally about becoming personally liable for the tax debt. Okay, so the best thing you can do is encourage compliance with lodgements, and then if they can't pay that tax debt, to seek either through yourselves, maybe a payment arrangement with the ATO, but at least open the dialogue with the ATO. And then if it's worse, the position's worse, and they just have a debt that they can't jump over the top of, then seek professional advice through an insolvency practitioner like myself. Happy to take questions, and I think there's a chat here. Okay. I might, if possible, I might just leave the questions towards the end, if that's okay.
They're mostly just comments, more than questions. Just
Okay.
relevant of the clients that we have and what we've seen and those kind of things.
Yep. Okay. So The other thing that's happening, so you talk about the types of industries that we're seeing at the moment. So
Mm,
most of my work is done in the SME space, um, where it's across the board. Okay, so
mm,
we are seeing companies, from virtually every industry. There are a couple of notable industries that we're seeing probably more activity rather than less. Construction. Okay, so in the most part, construction is a little bit different to all the other industries that we're seeing. Okay, and you probably see every day there are builders that are falling over. Right? And so there's just yeah, and we're getting a lot of those customers coming in. So you've got this perfect storm really that's happening in that building industry, and so what's happened is the government stimulated that industry. So, it there was incentives to sign up builders to do building work and you had a certain deadline that you had to do that. But coupled with that, you had fixed price contracts, an increase in the price of materials, and a substantial increase and shortages of materials through the supply chain and shortages of labor. So you had all those things happening all at the same time. And that's why, in my view, we're seeing a lot of building collapses actually occur. So, and it's still happening. So we've got still builders falling over, but what's happening now is it's coming back to the trades that interact with the builder. So that's your plumbers, your electricians, maybe your hardware suppliers. That's where the impact's starting to get felt because, I'll give you an example. I had a painter that came to me, and the painter said to me, "Well, the builder I do 100% of my work for has just collapsed, and he
mhm,
owes me $600,000." Okay. And so, again, when you're looking at your client's books and when you're talking to your client about their business, that's a real risk. Okay. Is a really big risk. So, um, take it outside of the building context. Let's say you've got Bonzo that's just fallen over. Okay. Let's say you're the catering company to Bonza and that is your only client that you've got. All of a
mm,
sudden you've lost your entire business. Okay. And to be able to, use a word like pivot to try and go out and get other customers, that's actually pretty hard to do when you're forced to have to do something really quickly. So when you're looking at your clients' books, when you're talking to your clients about their business, it's really important that you analyze, who are their customers and what
mm,
risks do they actually have that they might fall over that will impact upon your client. And so this diversity of having a range of clients is really important. You can still have big clients. You can still have clients that are that provide maybe 50% of the revenue or things like that, and that will hurt. But at least you've got other clients that if they fall over, you can actually your business just isn't lost overnight. So
that's something that we do recommend with sole traders or smaller bookkeepers, that they don't put all their eggs in one basket as well,
yeah,
because if
absolutely.
that company goes over, then they've lost all their income. And it's and if they're a sole trader now, Janelle's just asked the question, what happens to a sole trader? Now sole traders just go bankrupt because they can't liquidate because they're not a company. Or
That's right.
does does the liquidation process also go towards trusts? I know that yeah, so it does. Okay.
Yeah, so that I mean, these are good questions, and maybe look if people want to, have got questions like this, just unmute and just ask the question is fine by me. But so liquidations, small business restructures, and voluntary administrations all apply to companies. Okay, so either proprietary limited or limited companies. Um, with a trust, generally, a small business trust will have a corporate trustee. Okay, so when you've got a corporate trustee, again, liquidation, small business restructure, voluntary administration is all available. If you're a sole trader, a sole trader doesn't have those things that available to them in order to deal with the problems. The only you're going down the personal insolvency track as a sole trader. So tax office won't issue a director penalty notice to a sole trader. They'll just issue a notice to the sole trader and say, you've got this amount of tax debt that you've got to pay. So that's the difference between them. A sole trader can go bankrupt, okay, or could do what we call either a Part 9 or a Part 10 under the Bankruptcy Act. They're really the three formal bits of personal insolvency that a sole trader can go down. I'm not sure how many sole traders you actually do, but you probably see a few. They're probably not they're probably not the best um, sort of structure in many respects for businesses that are probably a little bit probably the larger of the small businesses. I understand why a lot of businesses would go and be a sole trader, but the options available are a lot less. With a company, you do get some protection, personally. So if a company goes into liquidation, personally, all of a sudden you don't become liable for all the debts. There might be a way, it might be through insolvent trading or things like that. I'll try not to get too technical here, that a director can, through basically a breach of director's duties, that they could become liable. But a company does provide that sort of protection, whereas a sole trader doesn't get that protection. If they don't pay the debt, they can go bankrupt effectively. Okay. Just to go back, we're seeing construction, we're seeing transport as one, as another one. You might have a number of transport clients that you're dealing with. These are small trucking companies, and again, it's a really competitive industry. The margins are really low, fuel prices are high, interest rates are going up, and that's now starting to have some impact. We're getting lots of transport companies, just stacks of them coming through as liquidations, and generally being wound up through the courts. So you've got those sorts of issues as well. And so what's also happened is a lot of creditors that were out there, people that are owed money, they were scared. If you're a larger company, they were sort of scared to try and jump in first to try and take action against small businesses, because they felt maybe they might be criticised for being too heavy-handed at the back end of the pandemic. Now what we're seeing is, now that, in particular, given the tax office is taking the stance that it's doing, a lot of creditors are jumping in pretty quickly because they don't want to be the last to actually get paid. So we're starting to see that roll through as well. And that's actually just, again, it's all a bit of a snowball effect. That's why we're actually getting really, really busy. As I said, really the big driver of it, the more activity that the ATO does to try and collect debt, the busier we actually get. It's a direct relationship to the action that they actually take. So anyway, that's sort of what's happening in the marketplace at the moment. So the types of things that you can do, and I'll mostly talk about companies at the moment. So one of the things that we ask is, we get a referral coming through. We'll meet with the director and the advisor. So whether that's a bookkeeper, whether it's the accountant, the solicitor, we'll meet with them. And one of the first things we ask is, to the director, what is it that you want to achieve? All right. And it's sometimes directors will have an answer that you might not anticipate. They might have said, I've been struggling with this business for, maybe 10 years. I've hardly made any money out of it. I'm working all these hours. I'm not getting any return out of it. It's all just too hard. And in fact, I had one of those. We've got a big company that we're doing at the moment. And in this particular business, unfortunately, the husband, who was the main driver of the company, passed away, and and the wife has continued to try and operate this particular business. And it's a fairly complex business, and it's a relatively decent size. Anyway, she just got to the stage where the debts were continuing to increase. It was becoming more and more difficult to actually operate the business. And she said, you know what, I just want out. I just want to liquidate the whole thing, and I want out of it, so that I can just go and, and the options available to them is that, given the state of the job market at the moment, it's pretty easy for a lot of directors to sort of say, okay, well, I can actually make more money working for salary and wages than I can working in this business and continuing to have stressful nights and things like that. I went out, an accountant called me a number of years ago and said, can you come out and meet with a client who's got a sports bar? And so anyway, I went out. Um, I went out to the sports bar, and yeah, it was a really good sports bar. It was really nice. It was very modern, and it just looked good. But I walked into this sports bar, and the location was terrible. It was in like a office complex up on the second or third floor, and it was like, well, but people come. Who's going to come here at night to this bar? Because it's just out of the road. It's not like your hotel down the road. So I went in, I had a look, and basically I looked at the figures, and this business was running hand to mouth every day. So basically, the money and the takings that it took today would go to pay for the food and the beverage for the following day. And it was on COD with all its customers. It owed the landlord a significant amount of money. The tax office was owed a significant amount of money. It had no money in the bank. And I said, in terms of options, um, you don't have really any options available because you can't make a payment arrangement with the ATO. The director had actually exhausted all of his personal resources. So he'd sold his house, he'd put all the money into the business, and I couldn't see really any other outcome other than liquidation. To me, the business wasn't viable, and I told the director that because the one role that we have is just to be upfront and very honest about what the position is. But we're not accusing anybody of doing the wrong thing or criticizing them because their business has gone bad, because it is what it is. Um, there's no, they've tried their, in most cases, small business owners try their best to try and get a good outcome. And they're all trying to provide generally for their families and to grow their business. And sometimes it just doesn't work. So I said to this particular chap, I said, how much money do you take home every year? What's your annual salary? And he's going, I'd probably take home about $40,000 a year. I said, what hours are you working? He's working 7 days a week. The bar wasn't open on Monday, but it certainly was open for the rest of the week, from generally from 11 till 11 or 11 to 1 o'clock in the morning. And I said to him, I said, you could make more money driving an Uber probably with those sort of hours. And anyway, I couldn't do it. The only thing I could suggest to him was to put the company into liquidation because I could see it just wasn't viable. And he said to me, look, I don't want to do that. I've been running this thing for 10 years. It's my baby. Um, I just don't want to do that. So anyway, I was driving back to the office after the meeting, and he rang me and said, look, I thought what you said. I want to put my company into liquidation. So he put the company into liquidation. And then within 2 weeks, I'd spoke to him. And so he was a cabinet maker by trade. He had picked up a job as a project manager for about on a six-figure salary with a company car. He was working I think probably from 7:30 in the morning till 3 o'clock in the afternoon on the sites. And he was working 5 days a week. And you could see his family. His family were relatively young too. So, and he said to me, it just lifted a weight off my shoulders to be able to do that. So sometimes that's the best outcome. And that's why we ask that question sort of up front as to what they actually want to do. So liquidation, simplistically, what a liquidation is gathering getting an independent person who's a registered liquidator like myself. We come in, it's very easy to do the appointment. It's just the directors call a meeting of members, and then the shareholders or the members then resolve to put the company into liquidation. So it's as simple as that. If I wanted to, I could probably put a company into liquidation within half an hour. It's that simple a process. So I gather the assets in. I work at the claims of creditors. I've got some investigations that I've got to do and a report to ASIC about why the company's gone into liquidation, why if the company, in my view, if the directors have breached any duties. And then from there, once the assets are collected, I report to creditors. There's a few reports that are done to creditors on the way through. And then when all that's done, the distributions actually occurred, then the company gets deregistered. So that's a liquidation process. Okay. Okay. So very similar in a bankruptcy. So remember, bankruptcy is personal. So for your sole traders, they can't pay their debts. Um, again, I had a client a number of years ago. Um, uh, an accountant referred these people to me. Their company had gone into liquidation, and they had all these personal guarantees. And so these people had gone out, husband and wife, had gone out, had got jobs for salary and wages. And then what they were doing was they'd given all these personal guarantees to suppliers, and they'd made all these arrangements with suppliers to try to meet those obligations. So, one supplier, they might have been paying $100 a week to another one, $50 a week to. And the problem was that the obligations, they just didn't have any money. So a couple of young kids, their house had been sold, and basically they were working for salary and wages, and every time they got paid, all the money would go out the door really quickly and would actually be paid to these suppliers because of the guarantees that had been given to support the debt for the company that had gone into liquidation. So anyway, they were really struggling. They were so stressed out. And ultimately, then they went bankrupt. Okay, and I became their trustee. And I was speaking to them a little bit later on about how things were going, and they said, "Look, our jobs are really good. We enjoy what we do. We're starting to get well paid, and we're starting to go up the ladder in terms of the organisation that they were working for, and they were both working for different organisations, but both of them were very skilled operators. They just had a bad business venture that had gone pear-shaped for them. And they said, bankruptcy was a really good thing for them because all of a sudden they didn't have to pay all those creditors. And whereby all their money would go to pay their creditors before bankruptcy, now they actually had money that they could then afford to take their kids out to a restaurant every once in a while, and they were starting to make ends meet. And it's so the weight was lifted off their shoulders, and their life was actually better because of bankruptcy. So bankruptcy is designed to not only protect creditors, but also to protect the bankrupt as well. So that's why an independent person, such as myself as a trustee, gets involved in those types of estates. Bankruptcy does come with some restrictions. So generally, someone is bankrupt for 3 years, and after 3 years, they're discharged from their bankruptcy. The big thing that is if they earn over a certain amount of money, and this is sort of indexed to the amount of dependents that they might have. So the more kids that they've got, the higher the threshold amount. But over a certain amount after tax, they've got to pay 50% of that amount into their bankrupt estate. So I think it's roughly around about, if you sort of say $80,000, $90,000 that they can earn before they have to make contributions. And sometimes, people that have gone bankrupt need a few years to get back on their feet. Overseas travel, if they want to go overseas, they've just got to ask their trustee for permission to travel overseas. Most of their household furniture and effects is protected. Superannuation is protected, so it doesn't form part of their estate. So, and the vast majority of creditors are included, but the only creditors that aren't included are maybe fines and penalties and child support. Okay, so it does actually offer, it offers somebody a fresh start once they come out of it. If they've got a good job like the couple I was speaking about, they were actually doing really well. They continue to get promoted. Um, and now probably 7 or 8 years down the track, they've got a pretty good savings record, and they'll probably be able to go and borrow and buy a house. So it doesn't have the stigma that a lot of people think that it does, and a lot of people go bankrupt each year. Okay, so this is the really interesting one. Okay, in terms of formal insolvencies. So sometimes people say to us, I can just go to my creditors, the people that I owe money to, and I can make a deal with each one of them, to pay them a certain amount of money. Um, and I don't need to go through a formal insolvency process. It's very difficult to do that, because generally what happens is you might have, say, a dozen creditors that the company owes money to, or even the individual owes money to. But you've only got a finite amount of resource, or a finite amount of cash, in order to deal with those creditors. And you might say, okay, well, I'm going to pay, I'll pay every creditor, and I'm going to pay them all off equally over 3 years. Unfortunately, what ends up happening is it all sounds great, until the reality is that one creditor turns around and says, well, I'm not going to give you 3 years to pay that debt back. I want my money now. I don't want, you're not getting 3 years from me, or you're not even getting 2 years or 1 year. And then all of a sudden you start making different arrangements for different people, and then you run out of cash. And then the whole thing just falls over. And so that's part of the reason why a formal type of insolvency procedure, sometimes actually, works a lot better, because it locks all the creditors actually in. So when the government was concerned about, the companies coming out the back end of the pandemic and the lifting of insolvency restrictions, and you might recall back about the insolvency tsunami that they thought might actually happen for small business. They brought in this thing called a small business restructure. So what a small business restructure is, a registered liquidator gets appointed as the small business restructuring practitioner. And our role is to assist the company in putting together a plan to put to creditors that they vote on. And if the creditors vote in favour of the plan, all creditors are locked into it. All creditors, with the exception of secured creditors. So those financiers that have got security over the company, or those companies that might have financed a vehicle or something like that. But all your other creditors, all your unsecured creditors, are all locked in, including the tax office. Okay, so these are becoming very popular. So for the first couple of years that this came into existence, not too many of them were done. I probably did one of the very first ones, just to see what they were actually like, see what they could be used for. But really, probably since the middle of last year, they have grown exponentially. So you find that now, every day, if I look at there's insolvency notices that come out, there is probably at least a dozen, if not 2 dozen, of these getting done a day. All right. So the process is, their eligibility is quite restrictive. So firstly, as a director, you can only do one of these every 7 years. Okay, so it's really important to know that. Now, we haven't because it's still relatively new, we haven't had somebody come to us that's already done one of these, but I'm sure that maybe in a couple of years' time that actually might be the case. So every director can only do one of these every 7 years. The total debt, okay, the total debt cannot exceed $1 million. All right. Tax lodgements have to be up to date. So that's all your tax lodgements, your income tax return, your BAS statements. If there's an FBT return, all the returns have got to be up to date. Okay. Um, and employee entitlements can't be outstanding. So so generally that means super. So if someone's if you've got employees that are owed annual leave, and they haven't taken that annual leave, then that's fine. Yeah, there's no issue with that. They're not outstanding. But if someone's, say, taken annual leave and has got paid for it, or has outstanding wages, then that they would need to be fixed up prior to becoming eligible to do one of these small business restructures. So you can bring your tax lodgements up to date. Um, you can pay your superannuation because that's generally the entitlement that is outstanding, is super. I haven't actually all the ones that I've done so far, I haven't come across any that have any other employee entitlement outstanding other than super. $1 million worth of total debt or under. And so if you if you tick all those boxes, you're eligible to do a small business restructure. And these are really good. So what ends up happening is the appointment takes place. So all the creditors that are owed money at that particular date are all covered by the plan that's been put forward. The plan, the restructuring plan, is really just a proposal. So probably the best thing I can do is give you an example of one that we've done. So we were dealing with a company where originally there were two creditors. There was the ATO who was owed $900,000, and there was a person that had loaned the company money for $150,000. Okay, so at the moment they would have been ineligible because the total debt was over $1 million. They had a payment arrangement in place with the ATO of $35,000 a month. They could see that they were struggling to meet the 35 a month, and so they came to us. And by this stage, the tax office debt was down to 600, and there was still the other debt that was sitting there of 150, so 750 in total debt. So they knew that they weren't going to be able to meet the 35. They knew that the payment arrangement would therefore come to an end, and therefore they would have to pay that'd be a demand effectively for the rest of the tax debt. So they appointed me as a small business restructuring practitioner. We put a plan together, and the plan was to pay 25 cents on the dollar over 3 years. Both the person that was owed 150 and the tax office agreed to that. Therefore, the debt was wiped off the balance sheet, and their amount that they have to pay me, because I collect all the contributions, the amount they have to pay me is slightly under $6,000 a month. It saved that business and saved 35 jobs in the process. So that's how these things sort of operate. So what happens is I get appointed, and then we've got 20 business days, or basically a month, 4 weeks to put the plan and a report out to creditors. Reports are quite comprehensive. There's a whole lot of stuff that goes into these reports. On the 20th business day, or before, but generally on the 20th business day, the report goes out. And then creditors have 3 weeks or 15 business days to vote on the proposal. And it's a tick the box postal vote. So there's a form in the pack of information that we send out. They tick the box simply, I accept I agree with the plan, and they send it back. On the 16th business day, we count the votes, and all those creditors that have actually responded to us, so we count their votes, it's majority in value that determines whether it goes through. So in probably 90% of the cases that we've got, the tax office is the one that it has the majority in value of the debt. In fact, in many cases, they hold 90+% of the debt. Okay, so it doesn't matter what all the other creditors say, as long as they agree, to it, it binds all the other creditors, with the exception of the secured creditors. But so we're talking about unsecured creditors. So it binds all those creditors, and then it means that the company just then has to comply with the plan. In the most part, these things are sort of probably getting through at 20 to 30 cents in the dollar. So you can see how it can actually save a small business. These are very good. The tax office gave us a figure, I think in October last year, and maybe with the seminar that we actually did in a couple of months ago. And they were accepting proposals 90, I think it was like 92% of the time. And certainly the experience that we've got, I've done 15 of these so far, and I'm waiting for the vote to come back on one today because we're at the 15th business day today. So I'm waiting for the vote to come back today, and only one of them hasn't gone through. So all the others have gone through. It's saved every one of those businesses and has saved jobs. So they're very good. They're a good news story, I think. They're very effective in actually allowing a business to get back on its feet again. The one thing that it doesn't do is it doesn't take care of personal guarantees. So from the company's perspective, it compromises the debt that's sitting there. But if the director has given a personal guarantee, it doesn't compromise the personal guarantee, and they might need to do something else in relation to that. But in a lot of cases, the debts aren't guaranteed. There's no personal guarantee, and it's just been a very, very effective outcome. And the clients that we've worked with that have done these, they have been over the moon. You can imagine the stress that they must have been under to try to actually deal with the large level of debts that they've actually got, and to be able to deal with it in this way is something that is very good. When it's accepted, the outcome is excellent, and it just lifts a whole heap of burden off their shoulders. So it's a pretty good outcome. Okay. Okay, so I'll just quickly run through this because I'm a little bit over time actually, so I'll try and finish this off pretty quickly. Voluntary administrations, they're a little bit different. So bigger companies, like Bonza, for example, that fell over during the week, that's involuntary administration. Generally, what will happen is there are two outcomes from a voluntary administration. They're a little bit different to all the other forms of insolvency, in that as the administrator, I will run the business or I will take control of it, and then I become personally liable for any debts that I incur during that particular time that I've approved. So there are really two outcomes from a voluntary administration, and it's in creditors' hands as to which outcome determines the company's future effectively. One outcome is the company goes into a deed of company arrangement, which is similar to just a proposal being put, and if accepted, then the company is bound by that particular proposal. Or if creditors don't accept it, or there's no proposal that's put, the company will go into liquidation. So they're really the two outcomes. So unlike a small business restructure, if the small business restructure, the creditors don't agree with it, the company just goes back to the position that it was before the small business restructure. So in other words, the debt's owing doesn't go into liquidation, and the directors remain in control in a small business restructure. Voluntary administration, administrator takes control of the business, and the outcome is either proposals accepted through a deed of company arrangement or it goes into liquidation. There's receiverships, which basically when you've got a secured creditor can appoint a receiver. The receiver works for the secured creditor. And then there's a Part 9 and 10 arrangements, which for a person, if they want to put a proposal to their creditors and bind them, depending on a number of criteria, their assets, the level of debt, is whether they go through what they call a Part 9 arrangement or whether they go through a Part 10 arrangement. So they're the different types of personal insolvencies that are available as well. So I know I've cover them off pretty quickly. But I suppose the most important thing is if you've got clients that are in financial trouble, just reach out. There's no obligation for us. Um, there's no cost involved with us actually meeting. We will tell them the options that are available, all the options. We'll tell them the impact of each option on them. And it's really up to them as to whether or not they then want to proceed. But generally, what ends up happening is we might have multiple meetings with clients over a period of time. Um, but in the most case, the clients have got to do something because um, they've got these financial problems that they need to be able to deal with. So on that note, they're my details, and Chris, who set this up, they're his details as well. I'm happy to take any questions, or I'll have a look at the chat and then I'll see what questions were on there. Okay, I can't see oh, I can't see your screen. Sorry, I've finished the presentation, but if you want to look at the screen, the recording will be available. Share. What other questions have we got here? Perfect time for this webinar. Just got off the phone with a client sobbing his heart out. It's difficult to hear business owners struggling to pay their bills. Yeah, and you're going to see a lot more of it. We're starting to see it impact on retail as well. So we see, discretionary spending with inflation and interest rates is starting to come back. I think we'll see a lot more retailers actually fall over. We saw Godfrey's fall over within the last few months. We've seen some swimwear companies fall over. There's a fair bit of that stuff that I think we'll see in the second half of this year. But the big thing is that earlier, so a client might have problems. The earlier they come in and get some advice, the more options they actually have. Unfortunately, a lot of the time, clients will come in and they'll come in, right on the death knell, and there's very few options that are actually available. So the quicker they come in, even though as soon as they identify that there's a problem there, and you'll identify it because there'll be tax debt that sits there. Basically, that's what we're seeing in SME businesses. There'll be tax debt. There'll be other creditors that are sitting over 90 days. There'll be cash flow problems. There'll be issues in terms of actually collecting accounts receivable. All these sorts of things come about. There might be staff movements as well. All these are identifiers of problems that business is actually struggling financially. Okay, we're going a few more screen things. Sorry for being late. That's okay, no problems. Is there a process for sole traders who have large debt, not just companies? What help can an insolvency practitioner give them? So that's, yeah. So sole traders, again, it's bankruptcy, Part 10 or Part 9 are the formal insolvency options that are actually available. If it's tax office debt, it's actually trying to get a payment arrangement if they're actually viable and can pay the debt. That they're the options that are actually available. We would go through, if someone referred that type of issue to us, we'd go through each of those particular options. We don't do payment arrangements. Generally, you as the bookkeeper or accountant are well placed to actually try and do that. If you can't, there are some companies that we're aware of that just do that for a living. I've heard it said that the ATO is not actually a secured creditor. Is that true? Yes, it's true. They're not a secured creditor. Okay, they're an unsecured creditor. There are different priorities that are given under the Corporations Act. So, for example, employee claims, which include super and sometimes include super guarantee, they're a priority under the Corporations Act. So in other words, they get paid generally first out of what we call circulating assets. So circulating assets are debtors, stock, generally, rather than fixed assets being plant and equipment. But they're not secured. client lodgements up to date, just just doesn't want to pay. But join the club. I don't think too many people like paying tax, and the 15th of May is coming along very quickly, and you'll have that discussion, I'm sure, with a lot of your clients that don't want to pay their tax that are on that particular tax lodgement. The yes, the small business restructure, I might add, is it's to do with restructuring, and I have had. So the very first one I had, um, which I did, the director was over the moon about the result. So she had $150,000 tax debt. All the other creditors were up to date. She couldn't get a payment arrangement with the ATO, and then ultimately she did a small business restructure. ATO accepted it because being the only creditor, and she was over the moon with the actual result. And I think she was paying something like maybe $900 a month, I think. And again, she offered 25 cents in the dollar in relation to that particular one. The um, the key thing here is she then had a friend who rang me up. And so the voting came through on the Friday, and I told her about it. On the Monday, her friend rang me and said, I've spoken to so and so. So this is fantastic. I've got a tax debt. And I said, oh, how much is it tax debt? It's 40 grand. I said, are you struggling to pay it? No, no, I'm struggling to pay it. I just don't want to pay it. Can you do the same thing for me? Or no, the answer is no. This is actually to restructure a business that can't pay its debts. It's an event of insolvency. It's not designed to compromise tax debt where the company can actually pay the debt. And one of the things that we do is what the tax office in particular wants to see that goes in the report that we send out is what they would get in a liquidation, a hypothetical liquidation, compared to what is offered under the proposal. And you would think that they're not going to vote in favour of something where liquidation actually offers them a better return. Okay, so um, anyway, the simple answer is can't use a small business restructure to just reduce tax debt where the company is solvent. I know Barry's head is going to get a good talk to tomorrow. Good, excellent. Um, Maybe applicable if he gets tax stuff sorted, small business restructure. Yep, I agree. Um, and they're becoming very, very popular. What happens if the arrangement is accepted by creditors and the company, and then the company defaults? Okay, so it terminates. So with a small business restructure, it actually terminates, and the company goes back to where it started from. So all the debts are all reinstated. They're all outstanding, unless, of course, it fall. You'll get proposals these days are generally over 18 months to 2 years, which is sort of in line with with what the ATO is sort of saying with payment arrangements, as I understand it. Um, so let's say you might be 12 months into a plan, and we've distributed some money out to creditors. They don't go back to the original amount that they're owed. They go back to the original amount less any monies that have actually been paid to them. But it terminates, and it just goes back to where it started from. So hopefully that makes sense. I think I've answered all those questions. So happy to take any others. Um, just ask. Otherwise, you've got my details, and you're welcome to give me a call. And if we can help in any particular way, we'd love to. And thank you for your time to spend with me today to talk about insolvency.
Thank you so much, Steve. I really appreciate your time. We just have one last question, which was how long does bankruptcy last for personal insolvency? I'm pretty sure you said about 3 years
Yep. So
before the discharge.
yep. So you can go bankrupt two ways. You can be made bankrupt by a creditor that goes through the court, or you can declare yourself bankrupt voluntarily. So generally, the period is 3 years, and it's 3 years. Let's say you've been made bankrupt by the court. It's 3 years from when you lodge and your bankruptcy form with a government organisation called AFSA, and they've accepted it. So you're generally bankrupt for 3 years, and then you get an automatic discharge, unless, of course, you haven't cooperated with your trustee, and the trustee can actually extend the period of bankruptcy for a further 2 years or a further 5 years. So ultimately, you could be made bankrupt for 8 years if you don't cooperate. But most people are made bankrupt. Their bankruptcy ends 3 years through an automatic discharge at that particular time. So hopefully that answers the question.
Fantastic. Well, thank you so much for your time, Steve. We really appreciate it. And yeah, we'll get that recording out to everybody. And thank you so much. And we'll talk soon. And I'll put your details up on my website in the resources section for everybody too.
Excellent. There. Thanks again, everybody. And I'll close the webinar off now. Thank you.
Fantastic. Thanks, Steve.